Welcome back to Gold Rush Reporter. I'm your silver analyst, here to break down what's really happening in the metals market today. Silver has finally done it. The price just broke above $50 per ounce, jumping nearly 4% in a single day. That's a massive move for a metal that's been quietly building pressure for months. But before you start celebrating or rushing to buy, we need to ask a serious question. Is this the start of a genuine breakout? Or are we walking right into another trap rally designed to shake out the impatient? Stick with me, because today I'll tell you exactly what's driving this move, what signals are flashing under the surface, and why this could either be the start of a powerful new uptrend or the setup for another painful correction. First, let's talk about what pushed silver over the $50 mark. It's not just technicals. This move has been fueled by renewed demand for physical bullion, a surge in industrial usage expectations, and growing speculation that inflation is far from dead. In other words, silver is being pulled higher by both fundamentals and emotion. That's a rare combination. When the spot price jumps like this, you can always expect mixed reactions. Some investors call it the breakout they've been waiting for. Others say it's just another B wave in a larger corrective structure. Both sides have a point, but only one can be right. Now, before we dive deeper into the charts, let me show you something interesting. The Royal Canadian Mint just launched its first ever 5-ounce silver maple leaf coin, an iconic design now in a much larger, more striking format. It's limited edition, and honestly, it's one of the most beautiful silver releases I've seen in a while. For collectors and stackers, that's a reminder. Physical silver still holds unmatched appeal, especially when inflation and currency instability are in the headlines again. But back to the price action. The $50 breakout is more than just a number. Historically, that's been silver's ceiling. It hit around $50 during the 1980 Hunt Brothers spike, and again during the 2011 bull run, before falling hard both times. This is why everyone's watching so closely now. If silver can stay above $50, not just touch it, it changes everything. It signals that the current bull market is not just another rally, it's a structural breakout. However, it's not time to declare victory yet. The chart looks strong, but the market psychology at this stage is fragile. Every time silver approaches a major resistance zone, emotional trading kicks in. Fear of missing out drives quick buying, followed by fear of loss when the price pulls back. That cycle can trap investors who think the rise will be endless. The truth? Silver is volatile, and its biggest rallies often come right before sharp corrections. So, let's get into the technical side of what's really going on here. Silver crossing $50 per ounce is a big deal, but the real question is whether this move has enough strength to hold. The first sign that caught my attention is the way silver has been respecting its Fibonacci retracement levels. If you measure from the previous market top down to the A-wave bottom, the current rally lines up perfectly with the 0.618 retracement level, around $51. That's the golden mean, the point where many B-wave rallies tend to peak before the final correction. In other words, this could still be a counter-trend rally, not a full breakout yet. Now, according to Elliott wave theory, what we're potentially looking at here is an ABC correction structure. You've got the initial A-wave sell-off, which shakes out the weak hands. Then comes the B-wave rebound. That's where we are now. A rally that makes people think the bull run is back on. But then the C wave hits, and that's where the market delivers one last leg down before the true bottom is set. It's classic market psychology. Hope, doubt, and capitulation. And if that's what we're seeing here, it means silver could still test lower levels before the real sustained move begins. That said, this isn't 2011. The macro backdrop is totally different now. Inflation is still running hot, even though the official numbers look controlled. Debt levels are higher than ever, and the global financial system is leaning harder on artificial stimulus just to keep the lights on. Every time the government prints more money or talks about new support packages, real assets like gold and silver react immediately. And that's exactly what we're seeing here. Traders aren't just betting on a technical setup. They're hedging against currency devaluation. The volume profile also tells an interesting story. Despite the 4% surge, trading volume hasn't exploded the way it should during a genuine breakout. In fact, it's been tapering off slightly since the initial push. That's not a bullish sign, that's hesitation. Real breakouts feed on momentum. This one feels like it's still waiting for confirmation. If volume doesn't spike higher over the next few days, that's a red flag that we could be topping out around the $51 range before rolling back. But here's the flip side. If we see a clean, close above $51 and then $54, this whole Elliott wave idea goes out the window. At that point, the B-wave theory dies, and we move into a full-on continuation phase. That's when you'll see momentum traders pile in, short sellers forced to cover, and silver breaking into territory it hasn't seen in decades. It's a tight line between caution and confirmation. For now, I'd say the market's sitting right in that zone of uncertainty, the point where anything can happen. Traders are excited, but nervous. Analysts are split right down the middle. And as a silver analyst, I'll tell you straight. Excitement is fine, but overconfidence is dangerous. The metal market doesn't reward emotional decisions. It rewards patience, logic, and timing. So don't jump just because everyone else is screaming, breakout. Watch the data, especially volume and closing levels. If silver can close strong above $51, that's your signal that this run might be real. If it struggles or fades below $49 again, we're likely in the middle of that classic ABC corrective pattern. Either way, the next few trading days will decide whether this surge is genuine or just another head fake. Now, let's move beyond the charts and talk about what's really driving this rally from the outside, because price action never happens in isolation. Whenever silver makes a strong move like this, it's not just about technicals. It's about what's happening in the political and economic landscape that's pushing money into hard assets. Right now, one of the biggest catalysts appears to be the recent government shutdown and, more importantly, how it ended. After a 41-day standoff, lawmakers finally passed a bill to reopen the government, and that announcement hit the markets like a burst of adrenaline. Stocks bounced, the dollar wobbled, and precious metals, especially silver, spiked hard. That's no coincidence. Every time the US government starts spending again, liquidity floods into the system. That liquidity doesn't just sit in the banks. It spills into everything. Commodities, equities, and most of all, metals. Silver tends to be one of the first to react, because it's a small market compared to gold, meaning even modest inflows can move it dramatically. But that's not the only trigger here. Former President Donald Trump's latest comments on Truth Social also stirred up serious speculation. He practically promised new stimulus payments, $2,000 for every American below a certain income threshold. Whether that's politically realistic or not doesn't matter. The markets reacted as if the checks are already on the way. It's what traders call anticipatory inflation. When people expect new money to hit the system, they start pricing it in immediately. That anticipation fuels the metal rally, because smart investors know that whenever the government hands out free cash, the dollar loses value and hard assets gain it. This isn't just theory. We've seen it before. In 2020 and 2021, every round of stimulus checks triggered sharp jumps in both gold and silver. The logic is simple. When you dilute the currency, people rush to protect purchasing power. So if another round of helicopter money is really coming, expect more of the same. But remember, easy money always comes with a price. Inflation never truly disappears. It just hides behind manipulated statistics. Now, let's tie this back to the current rally. Some of this momentum may not be organic demand at all. It could be artificially propped up by short-term optimism around fiscal spending. The end of the shutdown, plus the promise of more cash handouts, has created a temporary boost in confidence. But that confidence is fragile. If the stimulus doesn't materialize, or if inflation spikes faster than wages, we'll see a quick reversal as traders rush to take profits. What's ironic is that while the mainstream media keeps focusing on market optimism, they completely ignore the underlying rot in the system. Debt levels climbing, real wages stagnating, and consumer credit exploding. That's why, as a silver analyst, I see this rally as a double-edged sword. On one hand, it shows how quickly silver can react to economic policy shifts. On the other, it exposes how dependent the entire system has become on constant money printing and government spending. We're not watching a normal bull market. We're watching a reaction to fiscal insanity. The more the government spends, the higher silver goes. But that's not a healthy foundation. That's desperation disguised as growth. The problem is, once this kind of spending becomes normal, it's almost impossible to reverse without collapsing everything else. So yes, silver might keep rising in the short term. But let's not kid ourselves. The reason behind it isn't strong productivity or economic growth. It's fear. Fear of debt, fear of inflation, fear of losing purchasing power. And fear can drive prices a long way up before logic catches up. When you look past the headlines and start digging into what's really happening behind these price swings, you begin to see the same pattern that's been repeating for years. Every time silver starts gaining traction, someone dumps a massive volume into the market at the most illiquid time of the trading day, when New York is closed and Asia hasn't opened yet. No sane trader would ever do that, unless the goal was to smash the price, trigger sell stops, and shake out weak hands. It's the oldest trick in the book, and it still works because most investors don't recognize it for what it is: deliberate manipulation. This isn't speculation. Look at what happened during the last 9-week rally. Silver was breaking through major moving averages, sentiment was turning bullish, and retail investors were starting to pile in. Then, out of nowhere, a huge dump order hit the market, sending prices straight down in seconds. The mainstream media called it a healthy correction, but that's just lazy reporting. No trader trying to maximize profit would ever flood the market like that. It wasn't about profit, it was about control. They needed to cap enthusiasm before it turned into real panic for the shorts. Who benefits from this? The same institutions that hold massive paper short positions, the LBMA, COMEX, and the big commercial banks acting as their proxies. These are the same players who control both the price-setting mechanism and the storage systems. They can crush the paper price while quietly buying the physical metal at a discount. And lately, that's exactly what's been happening. Recent reports show billions of dollars worth of gold and silver being withdrawn from the LBMA and COMEX vaults every month. That's not retail investors. That's sovereign wealth funds, central banks, and large institutions moving their wealth into physical metal. They're not speculating. They're preparing. And while the media ignores it, the data doesn't lie. Delivery requests are skyrocketing. Supply chains are tightening. And the world's biggest money managers, the ones who used to mock gold and silver, are suddenly changing their tune. Take Morgan Stanley, Bank of America, even BlackRock. Their chief investment officers are now recommending that portfolios hold 20-25% in gold. That's not just talk. That's a complete reversal from decades of anti-gold sentiment. They finally realized that the 60-40 portfolio model is dead. Bonds are no longer a safe hedge, and fiat currencies are losing credibility by the day. These same institutions that once told retail investors gold is outdated are now loading up on it while still pretending it's irrelevant. This shift is massive because it signals the end of faith in paper assets. The big players are exiting quietly, while the public is still chasing yield in tech stocks and speculative assets. The insiders already know that the game is rigged. They helped rig it. And now they're positioning themselves for the next phase of the cycle. Wealth preservation through tangible assets. So, when you see those overnight dumps in the metals market, don't mistake them for weakness. They're not selling because they hate silver. They're selling paper to buy real metal. It's damage control, an illusion of volatility to keep retail investors from realizing the truth. The paper market is dying. This is exactly why holding physical silver is more important than ever. SLV and other ETFs are nothing but promises backed by custodians like JP Morgan, the same entities manipulating prices. Every ounce you hold physically is one less they can use to suppress the market. Now that we've connected all the dots, the picture is crystal clear. Silver is no longer just another commodity. It's becoming the frontline asset in a global financial shift. Central banks are quietly accumulating gold, but smart investors and sovereign funds are going one step further. They're moving into silver, the metal that's both industrial and monetary. While governments talk about green energy, electric vehicles, and solar expansion, they forget to mention that none of it works without silver. Supply is tightening, production is stagnant, and demand is exploding across multiple industries. This is not a setup for stability. It's a setup for a massive revaluation. The paper markets have masked this reality for years, but that mask is slipping fast. Physical premiums are widening, delivery delays are becoming standard, and major refineries are already warning of shortages. You don't need a PhD in economics to see what's happening. When the cost of acquiring real metal keeps rising, even as the spot price is being suppressed, you know the disconnect can't last forever. It's the same kind of tension that built up before gold's 1970s breakout, and it's happening again. Only this time, the scale is global. Meanwhile, the US debt has crossed levels no one can ignore anymore. The government can't stop printing, the interest payments alone are crushing, and foreign buyers are stepping back from treasuries. That creates a ripple effect. The dollar weakens, inflation creeps back, and tangible assets regain dominance. Gold gets the spotlight, but silver, the forgotten monetary metal, becomes the hidden winner. History shows that every major monetary reset sees silver outperform gold dramatically. When gold moves 2x, silver tends to move 5x to 10x. That's not hype, that's math, based on scarcity and leverage. What's even more telling is how quietly the biggest players are repositioning. You don't hear them talking about crypto hedges anymore. They're talking about bullion storage, secure vaults, and hard asset insurance. That's not random. That's the blueprint for the next wealth transfer. And as a silver analyst, I'll say this bluntly. Those who wait for the mainstream to confirm the breakout will already be too late. Silver is volatile, no doubt, but so is every asset on the edge of revaluation. The difference is that silver's volatility comes from artificial suppression. Once that suppression breaks, volatility flips direction. Instead of being punished for holding, you'll be rewarded for having patience. And when that moment arrives, the gains won't be slow or steady. They'll be explosive, fueled by panic buying and short covering. So, if you've been stacking physical silver quietly, stay patient. Don't let the noise shake your conviction. The numbers, the trends, and the institutional behavior all point to one outcome: a massive silver reprice in the coming years. The ones who understand this now are positioning themselves for a generational opportunity, not a quick trade. And that wraps up today's deep dive. If you found value in this breakdown and want to stay ahead of what's coming in the metals market, make sure to hit that like button, drop your thoughts in the comments. I read every one of them. And subscribe if you haven't already. I'm your host, the Silver Analyst, and this is Gold Rush Reporter, where we uncover the truth behind the noise and follow the real money. Stay sharp, stay informed, and as always, keep stacking smart.